It's a good time to be talking of tax-saving funds. Dhirendra Kumar, CEO of Value Research, is here to answer all your doubts. Hi Dhirendra, thanks for joining in on Markets at Lunch. Firstly, help us understand, how should an investor choose a tax-saver fund? What parameters should be kept in mind?
Choosing a tax-saving fund, most investors, when choosing an equity fund, they get carried by the short-term performance. In case of tax-saving fund, one should certainly ignore that. Look at long-term performance. Ideally, look at a full market cycle, and don't get perturbed by short-term underperformance, because when you invest in a tax-saving fund, you certainly buy it for 3 years. And it's very important to choose a fund which has done well in a rising as well as a falling market and overall generates decent return. So that should be the driver. Don't get carried by the short-term performance of a tax-saving fund.
Right. So Dhirendra, which tax-saver fund would you recommend to investors and why?
The first and foremost, what comes to my mind, everything else being equal, low cost will translate into a definite advantage of nearly 5 to 6% absolute return in 3 to 4 years time frame. From that standpoint, quantum tax saver. Other funds which I like for the superior performance is ICICI Prudential Tax Plan, Franklin Tax Shield, and Reliance Tax Saver.
Let's also take in some viewer queries as well, and we've got Hemant Kulkarni. He's got a query on behalf of his mother. She's a retired government employee and her earnings include interest income of around 4 lakhs per annum, which is not taxable. Currently, she earns around 10% interest on the deposits, and she wants you to suggest some debt funds to maximize her earnings.
Debt fund will not translate into any meaningful additional return. There is a possibility, because 10% return available to a senior citizen with great conformity may not be always available. So from that standpoint, I think debt fund may not be a superior option, but a small part of the money which is generating 4 lakh rupee of annual return, a part of that capital should certainly go into equity, maybe, and not substantially. And that is primarily to protect the value of the capital, because the capital which is earning 10% return per annum is going down in value. So 5 years from now, the 10% return may not be enough. So to protect the value of that capital, maybe in a very nominal way, maybe in a year's time, 5% of that money, and maybe in 2 to 3 years' time, 15% should go into a diversified equity fund.
Right, Dhirendra, second query is coming in from Deepak Shankar Narayanan, and he wants to know what's the best avenue to make investments for children.
It is possible to invest in to make any investment in child's name, and with the guardian managing that minor's money. I would suggest that don't get carried by any financial product which has child embedded into it, whether it be a child's ULIP plan or a children's fund. And depending on the child's age, you can figure out yourself what is the time frame. If the child is very young, maybe for a 10-15 years time period, then consider an equity fund. And in any mutual fund, one can invest in child's name. One can invest in the name for a minor with you managing that account.